Good afternoon. As you know, this week we had a three-part session. We were very lucky last night to have as guests Madame Merkler, who's here, and Monsieur Hugues Pirot. And the issue was the same. It will be on the other two sessions today, which is insurance, risk and insurance. And at 4:30 we'll have a panel. And that panel will be devoted to the same subject. And there again, we'll have 5 distinguished visitors contributing to the discussion. When we talk of risk within finance, we're thinking, of course, essentially of risk of a loss of a financial nature. We could talk of chance of losing money. Usually we talk of a risk when it's negative, and of a chance rather when it's a positive outcome. A risk is a possibility of losing money. And in the case of a commercial venture, the risk of a loss may mean insolvency for the firm, and that therefore we're dealing with the end of the existence of the firm. I mentioned already, we're dealing with a symmetrical issue, possibility of making a lot of money, which is beneficial within the perspective of the venture, and a loss which may be devastating. In recent years, we've been very much interested in the possible contagion of risk that the insolvency of one institution may lead to insolvency of others, because that particular venture may owe money to some others, and we could have what we call a chain reaction or a domino effect. And we've seen this in particular in that fateful week that followed the bankruptcy of Lehman Brothers in 2008, the third week of 2008, when at the time during that Sunday evening, and you must remember it was the second weekend of discussion around the possible demise of Lehman Brothers, people who were in that room discussing what would be the consequences of a bankruptcy of Lehman Brothers. There was a hope, as you may know, that Barclays would be able to take the business of Lehman Brothers whole, but that would have required asking the shareholders, the stockholders of Barclays, to take a decision around that a bit later in the week, and that was not possible. And we know that they reviewed all the possible consequences of a bankruptcy and decided they could go ahead, that there wouldn't be a major disaster ensuing. And these people were very knowledgeable who were holding these discussions. There was the elite, I would say, of the financial institutions in the United States. And they didn't think about the money markets. They didn't think something could go bad in the money markets, and that's where it actually happened a couple of days later. The figures were never really circulated about how much money had to be injected in the financial system in those days around the Thursday of that week. There is a American congressman who, being asked by the press and being, how would I say, pressed literally by the press, uttered a figure a couple of months later. I think he mentioned $600 billion. We know by now that Europe, Japan also had to inject some money in the salvage that took place in the following days. This is risk. And before then, I would say there was discussion. You can find some articles about what's called now systemic risk prior to September 2008, but it was not a major subject of discussion. It became so later on in the following years for obvious reasons. And we talk now of banks which are called systemically important bank as a term, meaning institutions, the downfall of it could have consequences for more than themselves, possibly igniting a chain reaction. The first reaction in those days, I'm thinking, I'm talking about the last quarter, the last term of 2008. There was no discussion in those days. It was what was said in all quarters was that there was only one possible approach: to dismantle institutions who would be systematically important, to the size of making out of them units which would not be systemically dangerous, meaning that their downfall would not necessarily ignite a chain reaction. Later on, we approached the issue. I mean, that was, I would say, in 2009 to 2010 was then dismissed, and we approached an alternative approach, a prudential approach, saying that we needed to improve raise the reserves that these types of institutions should make. But as you may know, in recent years, the very recent years, the banks would have to put up with these 1.5% to 2.5 additional reserves, have raised the issue that it would hurt their business, and we're discussing that again, showing that we are very quick at forgetting about how dangerous things were. It is the optimism, I would think, of the human race that we immediately forget about the big disasters and say, well, next time it won't happen that way. The issue we're facing now, when we make calculations saying, well, okay, if a bank is systemically important, let's raise it by 1.5% or 2.5% their reserves. How do we come up with these calculations? And I think that's the issue which is very, very central to the approaches we should develop. Because when you have the experience, which has been mine, I've been a model validator for a number of years in American institutions. You know how these 1.5 to 2.5% are calculated, and you know that the methodology to do that is not really valid. I mean, we have no proper approach to do that, and the reasons are numerous. The first one is that we assume now that any risk may be calculated. We use extensively probability theory in order to do so. But in the process for doing that, we simplify issues in such a way that I think we lose control of what we're actually doing. First, the first thing we do is that we assume that there's always a probability that can be assigned to an event, which of course is not necessarily the case. Some events happen for the first time, or the second time, or the third time. If a major, you may know that a couple of weeks ago, an asteroid came very close to Earth, 23,000 kilometers only. If you think of that the circumference of the Earth is 4,000 kilometers, it's very, very close. Do we have any way of assessing the risk involved if there was an accident of that type? We know that last time something like that happened, that wiped out dinosaurs. So I don't think that any actuarial science would actually be able to assess properly that type of event. Examples, events which are extremely rare and for which we don't have a time series. For events which are risky, we create time series. We look how many of these casualties happened over a period. We can do that for fires in apartments. We have long records for being able to do so. The difficulty we have in financial instruments, especially when they're relatively new, is that we may have only historical records for periods when everything went fine. that would be the case for, let's say, credit default swaps before 2008. If you looked at, the historical evidence of how things were, and I still have on my bookshelves, I have books about, that were written in 1995 or something about about credit default swaps, and risk is assessed in a very different way than it would be now. So the fact is that a probability cannot be assigned to every type of element. Before he became an economist, John Maynard Keynes, which trained in mathematics, had written a treatise on probability. And he's often mentioned now because he's one of these people who stressed the fact that some events cannot be, the probability of some events cannot be measured because we don't have any data that would let us know about how often they would occur. Another thing which happened is that, and this is normal that it would happen so, when people started developing probability theory, mathematicians, they started examining the issue on simple problems, because that's the way you can get into a field. You simplify somewhat the issue, thinking, well, let's look at it this way. Having a sketch, essentially, of the situation. Historically, it's an anecdote, but it's an interesting one. How did probability theory really take off? The problem that was set was the following. It's Chevalier de Méret, who was an amateur mathematician in the 17th century. He said, let's imagine a situation where we've been playing cards, a particular game, and then suddenly, for some reason, when our party needs to disband and we go home, and money is on the table. Now, we may have played half of a game. Looking at how we moved into that game so far, how do we divide the stakes on the table? And he was lucky enough that he had, as his correspondent, he had Blaise Pascal, who was a very good mathematician. He had Fermat. You may have heard of the Théorème de Fermat that people are still talking about, and that's the way it started. And as you may know, and this is very relevant, when you look at randomness, things that happen randomly, there's not only one way for things to be random. There's a kind of domesticated, tame randomness, which we call Gaussian distribution. And the Gaussian distribution, if you think about it, you have the following thing. You have the average situation. You have the median situation, which means that half of the cases are on one side of it and the other one are below. If you want the median, let's say, in income of a population, you rank everybody in terms of income, and you take the one in the middle, the one who has 50% of people down, lower, and 50% above. It can't be exactly 50% because you need to account for that one person in the middle, but that's the median. The mode is the most representative case, which may not necessarily be the average case. It's just a category in which you have most people. Now, in the way we've been looking at things in terms of random phenomena, we've assumed in nearly all cases that the distribution, meaning the way things are dispersed, is Gaussian, meaning that the average case, the modal case, and the median case will be exactly the same. And also that the variance or standard deviation, meaning what is the average difference between any datum being taken randomly from the medium, from the average. That's the standard deviation, that the standard deviation is measurable, that you can actually get a figure for that. If you think of very relevant things for us now, like, for instance, Solvency II. Solvency II is the new prudential framework which has been developed for the insurance sector, the insurance industry. And if you look at the methodologies which are used within Solvency II, you will see that the assumption is that, unless otherwise proven, a distribution of facts, of financial facts, is Gaussian, which is a very heavy, actually, simplification. Because when we look at the data And when we look at financial data in particular, we realize that in most cases in finance, we don't have that very tame, very domesticated type of randomness. We're dealing with much more complicated randomness, where there's a lot more disorder, where the mode is not necessarily the median and the median is not necessarily the average, and that you cannot make predictions of that type. You may have heard about these other type of randomness. It's often called fat tail randomness, that the tails of the distribution are not this nicely from the curve that you develop from the Gaussian distribution, the normal curve, which has that bell-shaped curve, but you may have things which are asymmetrical, or you may have things fat-tailed, because indeed the tails, the possibility that an event is out of the range, I mean very distant from the median or the average or the mode, may be pretty high. In most of our regulatory frameworks, we assume that very tame randomness, which is not the case that we actually observe. Why is the randomness in finance so different from what you may say, like let's say the distribution of spots on some type of insects, which will have that regular curve? There are many elements. One of the elements is that human beings learn. When they see something happening, they adapt to the situation. They will change their behavior. And therefore, when you look at the distribution before the fact or after, it will not be the same. It is often said about a particular model, which is called the Black-Scholes model in finance, which is for the pricing for options, that the distribution of behavior is not the same before 1987 and after. In 1987, there was a major crash in on the stock exchanges and the whole planet. It looks like agents on the markets have learned something, because the distribution of the facts on the option pricing has changed at that very particular point in time. That's one of the reasons why these distributions are not of a tame nature. Another one is because of the complexity we introduce into the system. We may introduce, for instance, triggers, and I'll be speaking more about triggers next week when I talk about Enron. What is a trigger? It's, for instance, to say, well, if we reach a particular threshold, we'll change our behavior. I'll give an example from Enron. Enron said, if the company is downgraded by the rating agencies, we will pay the difference for our clients, the difference in income that they would get from us. We will pay the difference. Now, because a company is downgraded when the situation is bad for it, if the company says at that particular point that they're going to pay cash to their clients the difference, it will be more difficult for them to do so, or they pretend they will be able, than it would have been before precisely the event. And so you can get, I would say, risk which is embedded in other risk and have some consequences from that. Yesterday evening during the talk, I made a little remark about the fact that another fact that would lead to a phenomena of this type, fat-tailed distribution, meaning that the dangerous situation that develops is actually more dangerous than was imagined. That there was some kind of what we could call a dialectic movement at some point in the downfall of Enron, that the very fact that a rating agency, it downgraded the credit of the Enron company because of the way the other two major rating agencies had made their calculations around risk, that the fact that, let's say, Standard & Poor's downgrades from AAA to AA would mean that automatically, I'm not giving the actual what happened, but I'll just give you the example, that if S&P downgrades from AAA to AA would mean that when Moody's make their calculation, they would downgrade from AAA to single A. automatically because of the actual impact of Standard & Poor's having reacted the way they did. Meaning that in that case, you can see then if Standard & Poor's has got a rule of the same type, the fact that Moody's downgrades it will make it do the same, and there will be a downward spiral, producing what we call a positive feedback. A positive feedback doesn't mean it's a positive event. A positive feedback usually is a disaster. Positive feedback means that in a positive feedback, there's a self-reinforcing effect taking place that may lead to the destruction of the system. For instance, if our body temperature rises above a certain temperature, there will be a positive feedback. If it's under that temperature, let's say 38, it will have a tendency to go back to the average, existing average. That's called, in that case, we call it in finance mean reversion. You revert to the mean, which is another word for the average. But if you go above a certain temperature, then the system will have a positive feedback as opposed to a negative feedback, and there will be a destruction of the system, meaning that it will lead to death. Another element which is interesting in terms of risk is the following, which is that had a lot of consequences in the current crisis. As I mentioned already, there are some type of risk in finance that we don't have proper methodology for assessing. And the difficulty that we were hitting there is the following, which is that the rating agencies are what we call in Europe private companies, but the Americans call public companies. They call them public because the public can buy the shares, but they are corporations, they are commercial corporations. And they put themselves in a situation which was recognized recently by Standard & Poor's, that they felt they were pushed by the existence of the others in order not to lose market share, to say in some cases that they could assess risk, although they could not. And it's part of S&P being honest by saying recently for a particular issuance of bonds, I think it was by General Motors, S&P very honestly said, well, actually, to assess the risk on that particular type of issuance, we don't have the methodology. And it was the case in the past, we didn't, but we did say we knew how to calculate it, but we should not have. What is interesting in that particular case is that the government then, for political reasons, just ignored the fact that the rating agencies said they couldn't assess risk because, well, you had to make sure that General Motors could issue some credit. But the reason why this was so dangerous that in the triggering events of the crisis was a particular financial instrument called the CDO, collateralized debt obligation, which is, if you think of a securitization of, let's say, mortgages, like there was a typical case for subprime loans. They called asset-backed securities, but these were essentially constituted of subprime. They were backed by subprime individual loans. The CDO was an instrument for which actually we didn't know how to calculate risk. It was made of different slices taken from different type of debt instruments, and the elements being put together, typically 150 to 200. And there was even one instrument called the CDO square, meaning square, like, square, 2 to the square is 4, where the elements constituting a CDO square were CDOs. And if you think that, how do you calculate the risk, especially if you calculate the risk of an instrument constituted of other instruments for which you cannot, to start with, calculate the risk properly. Now, how do you deal with that? I don't think we've talked even of any solution for that. I haven't seen anything in the way that we're talking about how to change the way we assess rating agencies to prevent them from actually rating instruments for which the methodology does not exist. We're not discussing that because we do admit that these companies are fighting for their market share, and that's a kind of moral hazard that you cannot eliminate, because you can't say, well, this company is actually dangerous because it's obsessed by its market share. It's been said recently when S&P has been sued by the American government for their assessment of some financial products. I read an article in, I think it was in the Wall Street Journal or Financial Times, say, well, what else could you expect from a company like S&P, which is obsessed by market share? But you cannot reproach a company to be interested in their own market share. Moody's does it too. Coca-Cola does it too. It is not possible to deal with that except to say something entirely different, which is say maybe we shouldn't ask commercial firms to assess risk. Maybe there's a moral hazard as such in the fact that they would give a rating to a particular company, having in mind that the competition may react in one way or other to the way they do things. I started with some general remarks like that about risk. I would like to talk a bit more now specifically about the insurance industry, the insurance sector, because as you know, it is central of the business very much to pool risk in such a way, using some very basic principles of probability theory, which is the law of large numbers, meaning that you can actually dilute to some extent risk by bringing it together and working out statistically on the basis of a mathematical approach how much of a premium you can ask for somebody who wants to be insured for a risk which is too much for that person, but paying a premium which is just a fraction of the possible loss, of the possible amount that would be paid for the actual casualty that is possible to do so. I'll give you a very ancient example. The Roman Emperor Claudius, he was, I think I wrote down the time exactly when he did that. No, but I know he was born in 10 AD, and he died something like in 45 AD or something. But he had said the following. He said, if any of the Roman merchant ships disappear at sea due to a storm, the state will pay for that. And that was an insurance. We have older example, even older examples. It looks like we have some text from the time of Babylon, where a principle of what's called an annuity seems to have been in force. The principle of an annuity is the following: an individual will pay to the state a certain amount of money that the state will define. And from that point, or there can be different clauses, but from that point, and for the rest of his life, he will be paid so much per year. It is a type of life insurance. Not life, I mean that the benefit would be at death, but it is an insurance for the individual that he can be assured for having paying a lump sum at some point to receive a particular amount every year. There are other examples we know about for Babylon, where in some contracts money was lent for equipping a boat, and the contract was specifying that if the boat was lost at sea, the money would not be necessarily need to be repaid. This is also a very early example. Before we had any mathematical methods to assess the risk properly and be able, therefore, to calculate a premium, there were types of insurance, particularly in the Middle Ages, the Renaissance, but we had no actual methodology for knowing how to calculate the premium and to calculate how much the down payment would have to be for an annuity. So essentially, insurance was bets done by people who had no notion exactly how you could assess the risk. But then probability theory started developing, and I mentioned that this discussion that had been started by the Chevalier de Méret and challenging well-known mathematicians of the time to develop a method. Another forefather of this approach is Cardano, Girolamo Cardano, who left his name in particular to a particular, it's called a universal joint, that part of the mechanism that's used in particular in cars at the junction of the axle with the wheels, and in French it's called cardan. I don't know exactly how you call it in Dutch, but it's from that name of that person called in French. Instead of being Girolamo Cardano, it is called Jérôme Cardan. And he was a gambler, how we would say, a sick gambler, because he lost a lot of money during his life, but he was very motivated to start writing about the subject, and he came with the first proper calculations on these issues. In the 17th century, John Grant in London, who was an amateur mathematician. He was by profession, he was a haberdasher, meaning that he was selling needles and threads and decoration for garments and so on. But he started collecting for the town of London mortality tables. And he's the first who have done in what we would call now a scientific method. He did it properly. He thought, we have a lot of texts of things he's been writing, and he's been writing, I would say, very knowledgeable way, thinking there might be a bias because Catholics would not record birth as well as Protestants because of the atmosphere of religion war, of data be collected differently in different neighborhoods of London and so on, of records that may have been lost because of a fire and so on. But he came up with very accurate, for the time, tables of mortality, being able to assess to a particular age, a life expectancy, and having very much, I would say, invented that method on his own. He started talking to mathematicians of the time, like in particular with William Petty. I'm talking here of the 17th century. William Petty was part of the Royal Academy. He was more of a professional mathematician, and they started working out ways for properly assessing how much you would pay as an annuity if a particular lump sum was paid by somebody who would get that insurance, and that you would actually calculate it from the age of the person, taking into account life expectancy. Because what was the case so far is that the same amount was required for anybody, independent of age. The question of age was not taken as a parameter, we would say, nowadays, of course, while we, of course, know that it's very much relevant. And despite that work of Grant and Petty, we had to wait another century in Britain. Actually, the first time that an annuity is actually, the amount is calculated according to life expectancy, you have to wait 1789, which is a century after these people were actually working. The major step there was made by somebody who joined the discussion between Grant and Petty, and he was called Halley. And we all know his name because he left his name to a famous comet, the Halley comet. At the same time as Grant and Petty were starting to work on this issue, the mathematical approach was developed in a what would I say, in a very modern way, jointly by Johan de Witt and Johannes Hudde in the Netherlands. They were, Hudde was the mayor of Amsterdam. De Witt was a famous politician who was actually got murdered, and they worked out a proper methodology for annuities and also for insurance as such. They're very much the ancestor of the reflection we have on these issues. And there's another name which is often mentioned, Richard Price. And in all the books about the history of insurance, you will see the name of Richard Price being mentioned, maybe instead of these four names that I just mentioned. But now we realize by now, by having gone back to his methodology, that his mathematics were much poorer. He was much off the mark, as opposed to the two persons that I just mentioned. But by that time, in the 17th century, what was called fire offices were started. And fire offices is very much what we will call today property casualty insurance, or P&C, very much the insurance, as you hear, for accidents and for fires typically. They were called fire office. It was the first name of that type of company. The first official one was called Hand in Hand, and it was started in London in 1696. 20 years later, the most famous probably of that period of insurance company was started is Lloyd's, and it still survives, although it has had, Lloyd's Bank in particular has had real difficulties during the current crisis. How did Lloyd's start? Lloyd's was actually a pub, and it was a pub where people who were interested in the fate of boats at sea would get together. And as part of a side business of Lloyd's pub, they started putting on the walls lists of boats that were currently at sea and where they were on the what the most recent information would locate them on the map, and if there had been any casualty, that would be mentioned too. And the Lloyd's company started from that particular way. What is the principle of very quickly? What the principle should be of an insurance company came to the surface. What was necessary was that the premium would be calculated in such a way that on the average, the possible losses associated to the probability of that loss would not make the company insolvent. It would, in actuality, make it possible for the company to make a profit. There was and that, I would say, that consideration is very much that of an average, of what is the value of the average casualty, the price, the loss, what is the amount of the loss, and what is the scarcity or abundance of these events in order to calculate an average. But I mentioned also the distribution, the way that the events are distributed, like on a bell-shaped curve. You need also to be sure that the most expensive of these losses that you would have to reimburse would not be of such an amount that it would make the company insolvent. So you had to take into account two elements of the statistical distribution: the average associated with it, the probability of the event, and also the distribution of the events in terms of what is the how many have you got of the lower price? How many do you have of the highest possible price? And make sure that you do not insure with a high probability of risk for an event that would actually make your insurance company insolvent. In order to be able to deal with these casualty and fires, there was a necessity that the events you would insure for would be a particular nature. They needed to be rare. They needed not to occur all the time, and they needed to be independent of each other. If they were depending on each other, then you may have a multiplication of casualties at a particular time. So if you think of the setting your apartment on fire, well, fortunately, it doesn't happen all the time. So this is one reason why it could be insured. The other one is that, on the whole, setting your apartment on fire is independent from anybody else doing it. Now, there might be cases where apartments all are set on fire at the same time, and that's why insurance companies need to exclude the cases where that should be the case, because it may happen that these events, which are now rare and independent of each other, may become very common and linked to each other. For instance, if there's bombing of the country, if the country is at war, or if the country is caught in a civil war, it's important that the company writes it in the contracts that these cases are not covered, because you've lost the two conditions. The two conditions are lost, which makes it possible for a company to statistically be able to pool different risk and insuring it for the price of a premium. An interesting, this is, by the way, rare and independent events have a distribution which the statisticians call the Poisson distribution, not because it has anything to do with fish, but because it's the name of the French mathematician who described it. Now, an interesting side remark about this is the following, which is that when securitization, like typically of subprime loans or for prime loans, I mentioned that the subprime loans were part of the financial instruments called asset-backed securities. Why asset? Well, because it is an asset, a house. But the reason why it was not called mortgage is because other elements were put together in very similar, with a very similar, what it was called, risk enhancement structure. For instance, leases on planes, recreational vehicles, a number of things, a number of elements were put together with the same category with subprime loans. Prime loans, meaning that the likelihood of the payments being made in a timely basis, were called prime, and they had a structure of risk enhancement that was different, because it didn't need to be it didn't need to create what is called a sinking fund, which is actually a reserve in the same way as was needed for subprime loans. There was a structure that was called subordination that make it possible to make these different tranches support each other in a quite complicated pattern, but I will not get into that today. But the error that was made in securitization is to imagine that we were dealing with a mechanism that was, to some extent, like an insurance mechanism. It was supposed to be the following: that, let's say that a mortgagee, somebody who was contracted a mortgage, who has received money from the bank and is repaying it over a period. Usually in the United States, a loan of that type is amortizing, meaning that you not only pay interest every month, but you pay back a part of the principal, a part of the loan amount of the loan has been given to you. That structure, which was standard until the beginning of the year 2000, had been set in the 1930s. When the American government had to deal with a situation where 25% of the American people who had a mortgage were defaulting on it, and they had to restart a new system, and that typical new mortgage that was standard was a 30-year mortgage with amortizing payments and a fixed rate for the interest. Why was the idea that? Well, the idea was the following: you would actually securitize. You would make pools, and a pool that's backing a mortgage-backed security or an asset-backed security is typically a pool of 2,000, 3,000, maybe 4,000 loans, individual loans, and you put them together and you make them behave like would be a state, a government, sovereign government obligation, and the behavior would be of that particular type. And you would think the following: you would say, well, these people pay their monthly payment. Well, the fact that they would not pay back, they would not make their monthly payment, would be a rare events. They would be independent of each other. Exactly the situation that would be proper for ensuring the situation. There would be a man in Detroit. He would, have long-term disability, and he wouldn't be able to make his payment. And there would be another one in San Francisco, and he would go through a difficult divorce. They would have to sell the house, etc. So we are in a situation where we're dealing typically with something that can be insured. And as you know, this is not the case. If you have a very serious economic crisis, then you precisely lose these conditions. If you think of a town like Detroit, where they close a major factory from Ford or from another automobile dealer, then it's 10 neighborhoods that are touched. We are in the same situation as a fire being developed because the neighborhood has been bombed. It's the exact same thing. And for the subprime loans, you got into a dynamic, and I will not go into the details of that, but as soon as the recession started, then people started defaulting on their house in a way that was not anymore rare. That's because they were losing their jobs, and not independent. It was dependent on the same economic situation. I'll give you one example of that, which is that I was working in the mortgage industry, and within a month at the end of 2008, 35,000 just in California of us were on the market. Our companies who had given mortgages to all of us, that was not my case, but that was the typical event that would destroy them. 35,000 people losing their job in a relatively restricted area. That was a type of event that would not that these insurance companies or that securitization mechanism could not deal with at all. So this example of securitization is a good example where you would think, at first sight, you would think, well, this is something very similar to insurance, and you would deal with the whole industry would deal with that in that particular perspective, and then you would realize, because of a dramatic event, that was not the case. Or you should have done, have a clause saying that the mortgages will be treated just like the insurance on the casualty and property and casualty, that if there's something of the nature of a civil war, of a war, that the mechanism would be set to a different pattern. But we hadn't thought about that at all. I mentioned what is the principle of a healthy insurance company, that you've properly assessed what is the average loss on a casualty, what is the probability it happens, and also that you need to calculate what is the event that would get you out of business, because you would have exposed yourself to a loss which is actually too high, and you would get into insolvency if this actually happened. And the methodology that was developed in order to do that, the name value at risk is relatively recent, but the methodology itself is much more old. It was developed at about the time, a bit later than what I mentioned before. It's at the end of the 18th century that the methodology was developed. The main contributors at the very beginning of setting the problem and starting working on it are the Marquis de Condorcet in France. He's born in 1743, died in 1794, and Laplace, the famous mathematician and astronomer, born in 1749, died in 1827. I've mentioned Laplace before in another lecture because he's the one whose principle is at the base of the mainstream economic theory of rational expectations. He's the person who said if we know perfectly the current situation, we will be able to know perfectly any time in the future. That's called the Laplacian principle. And at the time when modern economic theory in the 1870s, 1880s started, that was a view that was commonly accepted. The difficulty of economic theory is that it has stuck to that principle, although physics has developed in such a way that to tell us that this is not, we cannot hold a position like that. We've known about nonlinearity in dynamic systems. We know about chaos theory and so on. The difficulty there is that economic theory is not at all integrated the fact that the view of physics had evolved in the meantime. So what does the value at risk methodology do? Well, it takes precisely that value that would be the one for a particular casualty that would put the company out of business, and it would set as something that you shouldn't reach. Of course, it may happen. So how do you deal with that? Well, you define a probability that that event would happen. You take that probability as being very low, and you make sure that looking at your existing portfolio, looking at the risk you're incurring in terms of market risk, credit risk, and so on, that you do not reach that a particular level. These levels are defined within these regulations like Basel II or Solvency. They say when you use VAR, use like something like half a percent chance that the event happens over a particular period. Of course, you have to define a period over 1 day, over a month, over a year. Make calculations about your current portfolio and be sure that you do not reach that particular level, but the level that would put you out of business with a particular probability of the event happening, that probability being set at a particular level as being very low. So you calculate. You look at your portfolio on a daily basis. You assess it in terms of its financial value. You take that value that would put you out of business with the value at risk maximum that you should be taking into consideration. And you calculate the probability it may happen. And that probability it may happen should be lower than the one that's been defined by the regulator. Now, when I say maximum, I made that error deliberately, because that's the way everybody in the business who's using VAR thinks that value is. They think that value, that threshold, is the maximum loss you could possibly occur to you if you've done the calculations right. And the standard definition in French of value at risk is maximum loss for a particular threshold. Now, the way that the methodology has been devised, it's not at all a maximum. That threshold is not a maximum, it is a minimum. The probability is associated to incurring a loss which is at the minimal value of that threshold. That makes a major difference. And every mathematician you're talking to about VAR says, remember, it's not a maximum, it's a minimum. But nobody in the financial industry has ever understood that, and it's supposed to be a maximum. And I was looking this morning in some of the documents, and it was saying that within the industry, the value is even regarded as a probable profit or loss over the period, which has got nothing to do with what the model does. But I've seen that happen in training rooms, that people say, well, with the Black-Scholes formula, you can get this or that or whatever, and this has got nothing to do with what it means mathematically, but folklore, I would call it folklore, develops in banks of what something does and doesn't. And it may be very, very distant from the reality. I made an allusion to Solvency II, which is the new regulatory framework. A number of researchers, essentially academics, have been looking into the methodology, and they have assessed it in terms of its validity, mathematical validity. And I already alluded to the fact that a lot of the distributions of events, possible events, are assumed to be normal or Gaussian, which is probably not the case in reality. So that's a defect of the models as they are. Within it, there's also that a particular assumption that VAR is a maximum loss while it is a minimal loss. And also, there's never been any backtesting for the methodology. People have never bothered to find out if the methodology does work or not. There's no what is called regressive analysis. And there, when I say that, it's very much my past as a model, a financial model validator that comes back to the surface. Normally, when you use a model in an industry, you should do these regressive analysis, meaning looking back in the past and seeing how effective your methodology has been. Like, for instance, give you an example from the mortgage industry in which I worked. The distinction between subprime and prime is linked to the likelihood that the monthly payments will occur. Now, you have distributed people as being subprime or prime. Now, something to do is looking back in the past and saying, is it true that people are subprime? Were not as good as making their payments as the people were prime? Or maybe should we have put the threshold slightly differently? Because you may know there's something called the FICO score. FICO score is it's a scale in terms of risk, which is the one that defines the difference between prime and subprime. 620 is the level at which that separates people who are subprime from prime. Anybody who gets a FICO score, an assessment from his or her prior behavior as a creditor, as somebody who's been getting money from somewhere and needs to repay it. Anybody who had a FICO score below the 620 threshold was a subprime, and anybody who had a higher score would be prime. But did we set that level at the right place? Or did we see, for instance, that we could have lent money to people who were 580, for instance? So you do regressive analysis, backtesting, in order to assess the validity of your model. And that should be the case for every possible model. Now, as I said, VAR has never been treated in that particular way in trying to assess whether the methodology works in practice or not. For the anecdote, the main defender of the VAR methodology is somebody who is Philippe Jorion. And because we have the same initials and the same family name, sometimes some articles he's written are assigned to me and the other way around. He's the great defender of the VAR methodology. Also, a lot of these regulatory framework, and I will get probably some denial or support on that view here, a lot of the elements of how to define that, and that applies, as I say, altogether to financial models. Considerations which are consideration of just convenience sometimes really prevail on questions of the validity of the model at all. An example I think I've mentioned another time is that a particular variable which cannot easily be measured in the Black-Scholes model because it was not easy to assess it empirically. People have decided that's just a value you set, that you'd just say, well, implied volatility is 20%. The fact that you modify the understanding of your model just because something is not convenient is, of course, totally damaging to its validity. But for all these elements which are part of what is actually decided within a particular sector, it is in the process of bargaining that you decide what will happen or not. If you read the financial press, you will know that for Basel II, for instance, for Basel III, or for Solvency II, it's a lot of discussion between regulators and the industry itself that will decide what will be applied or not, putting the proper risk calculation very much into brackets, because of conveniency, because of what is possible for the industry. What if you want to maintain a particular profitability level? Is it possible to deal with something or other? And this is the major problem for risk assessment. If a type of strategy is profitable for a long period, you will not take the models which assess risk very seriously if a lot of profit can be made, even if it looks obvious that there is a probability, which may not be negligible, that things may go wrong at some point. And that in itself constitutes a moral hazard, as you know, especially if state authorities are prompt in that case just to jump to the rescue and allow the some institutions which have been performing very risky tasks to survive in that way, because you cannot have any clawback, for instance, on the benefits that have been made. When we're talking recently, in the past weeks now, the fact that the Barclays Bank in Britain is actually getting into that chest where the bonuses for the executives were, and for the first time going into that chest and taking some of the money out that were promised as bonuses to repay some of the fines that need to be paid because of, how would I say, defective behavior, like in the case of the LIBOR scandal, or some dealing with local authorities in particular places in England, in the case of Barclays, and taking some of that money that was promised as bonus and using it in order to pay these fines. Another, I would say, another difficulty in Solvency II is the fact that the assessment of the credit risk is still assigned to the rating agencies. And I mentioned earlier one of the problems associated to the rating agencies, that in some case, what I mentioned is that in some cases they were prepared to give some assessment about risk, although the methodology to calculate it properly did not exist. And as you know, there might be some other types of moral hazard linked to the fact that it is the clients, it is the issuer of the credit that's requiring an assessment of the credit risk. And the interests of the two parties are, of course, linked. There's also the fact that rating agencies don't have an opinion about speculative behavior and will integrate it as part of their assessment, because that's reality. Another very, how would I say, shortcoming of the methodology of the rating agencies is the fact that they rely on the standard economic models, which, as we know, may not be accurate. And that often the methodology that's been developed has a higher concern for coherence in terms of economic theory than for fitting the empirical data. And that's the difficulty that we've seen consistently. There's a very good book written by someone called Mackenzie, published in 2006 on these issues, that economic theory and financial theory have got a very, very bad record in terms of taking data seriously. That in case there's data are in contradiction with the theory, economic theory has been very bad as sacrificing the facts rather than wanting to sacrifice the construct, the theoretical construct. And I think I mentioned that before, that Mr. Black-Scholes, whose model was actually false for the pricing options, that Mr. Mackenzie says that they were aware of it when they produced the model, but that they were not adapting it to facts, to data, because it would have been too damaging for some established theory in economic theory. The tradition when we have a panel later on is that we finish a bit earlier to allow for a little break. But there's still 10 minutes for questions or for this discussion about what I've been talking about today. So if anyone would like to make a remark or ask a question. Otherwise, we will take the break. There's a question there.
Following the talk that took place yesterday evening, I've read this morning a manifesto that is widely available on the web, and that has been widely signed and is recommended by the physicists, part of the financial modeling community. And this manifesto, we can draw a parallel with your introductory statement that not every risk can be measured. Assessed properly, and so it's stating exactly the same thing. So it's very humble on their part, and that's nice. But then their take on this is that financial models remain anyway the right approximation of the risks that they are supposed to calculate, and that the financial modeling community actually shouldn't strive to improve those models that much. Because they work anyway, and by work anyway, they mean that they create profit, and that's people that actually use them, since there is no competitive advantage between the different agencies. They all use the same models that we know.
Yes.
Then it's okay as such.
Yes.
So that's what the financial community, modeling community, is actually in a manifesto.
Yes. Right.
Model. So my question would be, should actually science strive to find the right models and improve the models that exist to assess the risks that right now we can't measure and assess properly?
Yes.
Or should we simply forbid the activities that actually imply risks that we cannot measure?
Yes. Yeah. Yes. Well, I mean, you know my own position, because in the press, in a number of my columns in the French daily Le Monde, I have defended the view that what we cannot, that the instruments for which we cannot assess the risk associated, they should simply be forbidden. Now, the reason why that issue was never stated that particular way was, as I mentioned, that the rating agencies were volunteering ratings anyway, for fear of losing some market share, and therefore there was no recognition. I mean, we knew that all people who were part of the business, that these methodologies were wrong, that they were using, but because they were prepared to assign a rating, now the issue which is raised there, who should forbid these instruments from being used? Because, as I said, to my knowledge, I haven't seen in any of the texts that are proposed now any formal prohibition of CDO square. Everybody knows it was a recipe for disaster. We should never do it. We should never do it again. But is it prohibited anywhere to do so? I haven't seen that. And so the question raised by these people is the right one. Instead of always, how would I say, instead of always relying on self-regulation or in thinking that the reserve, we can calculate some provisioning, some level for reserves, we should realize, let's take the example of Basel II, Basel III. Okay, let's say we assess now better the risk, and we say that on some particular type of instruments, we should have reserves that shouldn't be at all like 2% or whatever, should be 35%. The industry would say, and they say already, I mean, they already cry for when it's 2.5%. If it were 35, you may think it would be dissuasive. They would simply not do it because they wouldn't be profitable. Maybe we should be bolder in doing the proper calculation and taking into account to some extent, in some way, the fact that some risks are really much higher than we think, and maybe that if we're dealing in truth with a risk which cannot be measured at all, that the instrument should simply not be banned. But the issue then is who would ban it, because as you know, in all the decisions we take, it's part of a bargaining between the industry and the regulator. And how would you imagine a situation where the people who would make a lot of money, at least for some period, on some instrument would volunteer not to use it? I would say that's the logic, very logic of profit. We should remove the bailout clause, that if they do that, that we automatically jump to their rescue if the losses are incurred. I hope that by saying that, I'm already encouraging some of the people who will be part of the panel to respond to me, hopefully in a very, how would I say, antagonistic way. Anybody else? There's a couple of minutes left for any other question if we wish to. No? Then we'll make a short break, and when we'll be back, it will be the people of the panel being here with Steve Rombout, who will be orchestrating the discussion. Thank you.